Hello, everyone. Welcome back. Welcome to X Spaces. It's been a busy week and a good week. Very interesting week in the markets and on Twitter. A lot of good stuff to talk about. Twitter's getting rock and roll. A lot of interesting comments out there. Oleg, good morning.
Hi, Jerry. Good morning, Jerry. Hi, Richard. Hi, Alp. Hi, Marcel. Hi, Absolute. And all the other my friends I see here. So, it was really busy and interesting week because every week for me is busy and interesting. Yes, truly so, more or less. I was thinking about, first of all, I was very impressed. I was very impressed by Richard Brennan and Neil's podcast, and really, I'm always impressed when Richard talks about his scientific approach, about his philosophy, because I really love scientific approach. I love not to divide our life, our principles of nature, as you all know, with trend following. It's the whole thing, the principle, universal principles we can apply to every field. And I mentioned that very successful people of all times applying the same principles we do, not by and hold, not prediction, even not even mean reversion. I think it's a very meaningful evidence for me. And I want to add to a topic about choosing the manager that when choosing a manager to invest, I think a person must ask him what is his philosophy, what his values most, what is the logic behind this system. We have talked a lot about this, but it's very important because long-term philosophical and investment horizon it must be, because if a manager don't have a long-term picture, it's not a good sign. And of course, I think that if a person is short-term manager, it's not bad, but even a short-term manager must have his must apply the most important principles of trading, and he can learn it in the best way of learning how our classical trend following systems works, because our principles of classical trend following, as I have said, they're universal, and they teach us how the whole market systems are organized, the complex system. We beat our rules, with following our simple rules, the very complex system. And so, of course, a short-term space is a little bit different, more noise, of course, yes. And I have said before that I think some bells and whistles, some filtering, or in short-term space is acceptable. And in long-term trading, I don't see that we need this. But and of course, the benefit of short terms is a diversification benefit, because I have made a lot of big researches on the topic, and I have mentioned that in the short term space you can diversificate, for example, 100 hours breakout with 200 hours breakout, and it will be a good diversification benefit. So, in short-term space, one of the biggest benefits is you can trade less markets to be more diversified, and you can be diversified in the system. So you need less money to be more diversified. So short-term space also a part of our space, but it must be done according to our principles. And if so, it can be called also a trend following system, or trend following based system. So here are my thoughts for today. I see Moritz. I'm very glad to see Moritz. Always glad to see Moritz and to listen Moritz. So let's get started. And I'm very happy to be here as always.
Thank you, Oleg. Great job. Appreciate you doing all of that and letting us know how things are. Yeah, so one of the things I listened to this week was Richard's podcast with Niels. It was really good, and they got into a lot of good topics. One that I was particularly interested in is the cross-sectional momentum discussion, and my own thoughts on that. And then I was also interested. I thought it was pretty interesting. The first thing that we talked about was the idea of some CTAs. Oh yeah, some CTAs taking out this the long equity exposure or minimizing the long equity exposure. This is the Stockholm syndrome, the idea of we want to fit in so much with the portfolio, traditional portfolio approach, and then allocating 5 or 10% to manage future CTAs. We have no life other than what you're willing to give us, you traditional portfolio people. That we're on this planet only to take care of you. And if you want us to not, we'll screw up our own trading ideas, our own portfolio, our own performance, our own historical track record that we're going to leave for our children to see and our grandchildren for the rest of time. We're going to purposely screw it up because we so desperately want to fit in to your traditional portfolio that we may not, then we're willing to not trade equities on the long side or at all, I guess, because you already have these equities, notwithstanding, I guess. You have bonds too, and they all lost a lot of money last year, but we didn't because we were short them. And there have been times when there have been downtrends, massive downtrends in stocks, and CTAs were short indices and did pretty well during that period as well. And I thought that it was all pretty good. It was all very interesting. But I thought that Niels had a very good point. And I've obviously had a lot of practice trashing. Mike Harris always has become very good at tweeting about how I trash things. And so I've a lot of practice, obviously, as you just heard, trashing this whole idea and not trading stocks and fitting into the traditional portfolio obsession. And but Niels brought up a very good point that I had not even thought about, and I thought this was very good. And this is his reminding us like how the if you didn't trade this whole sector of equities, and it could be applied to lots of different sectors, but if you took this out of your portfolio, there could be a big impact on how you trade the rest of the portfolio because your vol could be higher, you could be losing money at a period where you don't have these equities, so maybe you're not trading as large, you're not able to be short as many bonds last year as you might be if you had a more diversified portfolio. So these unintended consequences, or they're pretty foreseeable consequences that could impact your the overall performance and actually uh, deliver less crisis alpha from the managed futures CTA by not including equities in there. And I think Richard might have referenced some of the ideas of the that some of the other CTAs mentioned on the CTA series, Top Traders Unplugged, where I think numerous of them mentioned this idea and that performance would be worse overall if you didn't have equity exposure. If they didn't include the equities, even those stupid indices in their trend following programs. The last thing the CTAs need, my God, man, is worse performance. We're sort of always fighting and fighting to evidently, there's all these compromises that the managed future CTAs want to talk about as relates, well, we have to do it. Oh my God, we have to do these things because clients like them. Well, then, that's the ultimate argument. There's nothing anybody can say. If a client likes it, then you just have to move the fuck on. There's nothing you can do. Change what you're doing, alter what you're doing, because, quote, clients like it. Clients like Sharp, according to Mike. Enough said, Jerry, quit bashing Sharp. Clients like it, then you have to deal with it. Well, he has to, or others have to. So I thought that was pretty interesting that Niels brought that up. But of course, it was a lot of other great stuff in there. And I'd like to spend a little bit of time with Richard talking about that. And if you're interested in that topic, Richard, or you want to go straight into um, cross-sectional versus um, time momentum, trend following is what we do. And I thought that I wanted to define what that cross-sectional is the way I understand it. Cross-sectional traditionally, I think this is what y'all were talking about, is you have 100 stocks and you kind of do some sort of relative uh, analysis and you say, okay, these are the 20 out of the 100 or whatever, these are the 20 strongest, these are the 20 weakest. So we will go long those 20, go short those the 20 weakest, and then we will rebalance monthly, quarterly, or something like that. And comparing that to taking those all, I guess, 100 and trend following those individually using their own prices. And, some you'll be long, some you'll be flat, some you'll be short. But you could be long 100 or short 100 or anything in between and not have this balanced portfolio. That maybe that's one of the reasons that academia came up and kind of, at least they used to kind of like default to talking about trend following. It was going to be talking about cross-sectional. Anyways, good morning or good evening, Richard.
G'day, Jerry. G'day, Oleg. Hi, everyone. Yes, look, I think Niels probably regrets that he let the chains off me in that last episode because towards the end of it, I was trying to strive to a punchline, which was having a go at classical economics, and but look, I could have done it better. But anyway, look, the conversation started. And Jerry, I totally agree with your comments regarding this appeasement of investor appetites by, forcing, the CTAs to change, to adopt what's in the interests of the investor. Because, my whole argument with Niels was coming to a conclusion that industry has stuffed things up for the last X number of years they've been alive in their inability to deal with these significant crisis events, say 40 over the last 400 years, and their continuous reversion back to traditional economic models, as opposed to accepting that there's a fault with those models and looking to new models that might look at things in different ways, in more realistic ways, which would advance the science of economics effectively. But there is this incredible sort of resistance to change within the economic community. So, we're still having these discussions these days about using Sharp. And because investors like Sharp, it forces the CTAs, the trend followers and the CTAs to bow to the subservient will of the investors to follow a metric that is so wrong, and has been demonstrated so many times to be wrong, LTCM, the Ponzi schemes, all of these things, that it tells me that we are not, as an industry, we are not being responsible and acting in the interests of investors, because with our knowledge, with our capabilities, we should be advising investors what to do. We should not be bowing to what investors want. And this is where I think we need to take a line. We need to take a line in the sand saying, we know what's good for you. Don't tell us how to adjust our portfolio for your appetite, because you don't have the experience in industry. You don't have the 40-year track record. There's a lot of reasons why we need to stick firm to our ground of enforcing the fact that we are acting in the investors' interests. And I feel that a lot of the CTAs are losing their way, and they are going down the line of appeasing investor appetites. They're looking at how they can click their models into traditional portfolios, all of these things we've talked about. But you're just inviting disaster with some of the traditional portfolios which to click into. And there's only so much a trend following component to a traditional portfolio can do. And as Moritz said last week, which was very good, there is no guarantee it's going to offer crisis alpha. Yes, it has significantly offered crisis alpha in the past, but there will be a day where, if we sing to the tune of offering crisis alpha, there will be a day where we don't offer that crisis alpha. And because we've appeased ourselves to the investor appetites, they're going to come swinging back at us saying, where was this protection you were going to offer? You said you could offer us, when we can't offer it, as we all know. But the conversation, I suppose, started out talking about absolute momentum. Now, the reason I started out talking about absolute momentum versus cross-sectional momentum is because I feel there's a mistake going on in industry. This is just personally, my own personal feelings, in their reduction of their reliance on absolute momentum to entertaining a cross-sectional viewpoint of how to manage risk with their portfolios in these markets. Now, the reason I say that is that I view absolute momentum as the thing that is fundamentally responsible for driving price action. So you know how the trend followers say they follow price. What they are actually doing is following absolute momentum. It's the clearest, most fundamental signature of price. When you are looking at cross-sectional methods, you're looking at a derivative of that function. It's secondary, it's not primary. The primary reason for why prices move, as Jean-Philippe Bouchard found out for the major price moves, 90% is because of endogenous factors. 10% in his microstructural price studies was exogenous factors. That 90%, the endogenous factors, is what is driving absolute momentum. So your interpretation, Jerry, of the cross-sectional, that is just one perspective of a cross-sectional process. That's where some particular models are looking at how they can use the current momentum that is exhibited by a single return stream in a portfolio of return streams to look at something like rate of change and to establish that there is a relative strength in a particular return stream compared to other return streams, relative to other return streams. So what this does is this forces them away from principles of diversification that we think is so important in absolute momentum terms, for them to reduce their diversification to look at selections from their ensemble of return streams to say which one is the best performer currently. Now, this is therefore integrating a predictive method into their process where their assumption is that the strongest performing return stream at a particular point in time is going to endure into the future. Now, we in our discussions we've had over many, many months on Spaces, we talk about the chaotic features of the tail regions of a distribution. And when things get chaotic, we lose our grip on predictable patterns, such as trending patterns, volatility, all of these things which work well within predictable environments, but they become inherently unpredictable within the tail regions. So by virtue of the fact that the cross-sectional guys use these methods of selection bias, selecting which ones to select as opposed to all of them, they are reducing their diversification. They're looking at models that are linear in nature, applying Gaussian rationale. They're doing all of the things that we don't want to do in our absolute momentum world. And in our absolute momentum world, we are guided by non-linear mechanics. In the cross-sectional world, they are being guided by linear mechanics. When they are in the linear world, things such as the Sharpe ratio, Markowitz's efficient frontier, standard deviations, they all apply within the normal Gaussian distribution. They work well within Gaussian premises, but in chaotic environments, they fall over. That's where Sharpe suddenly is tested and found to be found wanting when it gets into an environment that exceeds the volatility thresholds of their models, their predictive models. So when long-term capital management with their Gaussian models was thought to be unsinkable, the Titanic, as it was doing this magnificent Sharpe ratio, that was all within the confines of predictability, their thresholds. When the market price actually exceeded those thresholds, it was just like the story you would have seen in Margin Call, where they realized that their predictable models, the thresholds were being exceeded, and suddenly they found this negative skew arising from a model that they never knew had that negative skew embedded within it. This is this warehousing risk that we talk about frequently. This is where things such as the kurtosis and the skew of distributions become so incredibly important, which is not recognized by Gaussian models. Sharpe, standard deviation, all of these risk metrics being assigned by the predictable class of the models is not seeing risk the way a trend follower doing absolute momentum is seeing risk. So look, I'll just stop there, and if there are any questions, just go for it.
I wanted to make a couple comments. One is I remember back in 2008, I think, or when there was during a really big sell-off, that this sort of relative momentum, relative cross-sectional trading was tremendously underperformed. There are times that I can see in my performance of going long and going short individual stocks where on some days or months, all of my longs go down and then all the shorts go up. It's like this reversal, for whatever reason. People are taking profits on the longs. I have the longs and I'm letting them run, so they're getting out of those and they're looking for the bargains on the shorts. And so the S&P can kind of be unchanged or whatever, and I've lost every which way on all my stocks. And then what they noticed during this period of when equities sold off really bad was that the same thing happened. Is the longs just got crushed, and there was no protection and diversification in the shorts, the 20 shorts or 50 shorts. 50 longs, 50 shorts, 20 longs, 20 shorts, whatever they choose to do. And so what they came up with, and I can't find this article, but it's probably written by AQR, is that, hey, let's add time series momentum on top of it. I mean to tell you, man, if you're screwing up anywhere in this world, time series momentum, trend following, to the rescue. So of course, yeah. So if we overlay, like, okay, we'll go long the top 20 and go short the bottom 20, but only if the top 20 has made an upside breakout or the bottom 20 have made a downside breakout. So so just look, dude, just get rid of the cross-sectional and just, I thought that was pretty funny. So another thing too, I sort of think that this relative strength thing is a problem. It's a problem, but there is a way to make it not a problem. So maybe we're not on the exact same page here, Richard, but like the problem is having a universe of, let's say, 100 and then going long 20 and short 20 and then rebalancing. Therein is the problem, because what's happening there is that it's not a robust entry and exit. You are not doing the same thing all the time. You're making these entries dependent upon other markets. Where do we fit in with the other markets? The 20 that you go long one time could all be in uptrends. The next time they could all be in downtrends. They're just the 20 that are short are in way worse downtrends. So everything is going down and you're kind of buying in this downtrend. So I think it really suffers from a lack of consistent application of a rule. That you have rules, but they're not, you're not consistently applying you're consistently applying the rules, but the rules are causing inconsistent behavior, which you're not always buying the 100-day high or selling the 100-day low. It's this random entry and exit, and it's based upon what other markets are doing and how any market fits relatively to those. Number three is, I think there is a way to do this and make it great. Now, theoretically, I'm not saying I've tried to do this, but I don't see a problem with it. But it does highlight the ultimate issue here, which is I think it's totally fine. For instance, well, let's just start with the easy one that everyone will agree with, probably. Okay, we trade dollar Swiss, we trade dollar yen. I trade Swiss yen. And you know what? People in Japan do as well. They don't trade dollar yen, or maybe they do, but trading Swiss yen is totally fine, or trading markets, crude or gold in your own local currency, taking that into consideration is totally fine. And so I think if you wanted to rather than taking 100 markets and going long 20 and short 20 based upon relative strength, I think if you created a lot of markets, these synthetic markets, Swiss divided by yen, crude divided by Swiss, I think there is a way, because these are individual markets and you are doing every trade in crude Swiss, you're buying the 100-day breakout, you're selling the 100-day breakout, and you're fundamentally applying these rules consistently every single time. I think that could possibly work. There are issues with doing that need to be overcome. However, by converting those 100 markets into thousands of markets, each one divided by the other, I think that can be trend followed in a way that does not. I think the other way, the cross-sectional, is totally bankrupt. That's not going to work very well. And I think, because that's the issue, is it's this inconsistent approach to putting trades on and off that cross-sectional gives you, whereas our approach is consistently doing the same thing all the time. I got criticized this week by people for using Sharp and for not getting out of trades quickly. Some guy called me a nasty name for Jerry thinks if you have a big, huge position on, then it's wrong to get out of some of it. Look, all of this stuff revolves around the same issue, which is it's not wrong to get out per se. It's wrong for me because I'm obsessed with following these simple rules, one entry, one exit, and a stop loss, and applying them each and every time. And as much as I would like to get out of OJ and cocoa and some sugar now, because maybe they're going to crash and I'll give back too much profit, I've seen no evidence that discretionary exits or adding exits, dynamic exits, gets me out effectively before my one entry, one exit stop loss gets me out, is an improvement on making money. And that using Sharp, of course, is not a good indication for me as it relates to the loss of capital. So anyways, what do you think about that, Richard?
Yeah, look, in general, I'm agreeing a lot with what you're saying. My concern is this, and this cross-sectional thing, at the moment we've been talking about cross-sectional methods such as that which chooses the top 20 performers, that which choose the bottom 20 performers. But cross-sectional methods also apply to dynamic position sizing and volatility targeting, which we hate. And there is a good reason for why we hate it. It's because it is compromising absolute momentum. Because what it is doing is applying linear models to manage risk of a portfolio cross-sectionally. And so, in other words, when you're looking at the correlation relationship spatially, you are dynamically adjusting your position sizes or your volatility to produce a target, which is a cross-sectional spatial risk management measure. It is not a a time evolution, absolute momentum risk approach. So this is where the bifurcation in viewpoints occurs and why we're debating it so much, in that those that apply those spatial methods are doing a different thing to what we're doing. It's not saying it's bad what they're doing, but I personally believe what we're doing is the best, because I view this world as a non-linear, uneven world, unfair world, but a brilliant world, a majestic world. Because of this unevenness, there is no even playing field in this game of trading the markets. Some approaches are better than others. And I think our approach is the best approach in managing risk over the long term, because we are applying structural risk mitigation measures in a time series manner, in an evolving manner, along the course of a return stream's evolution. This means we are never in a situation where we're going to get the massive negative skew event. We certainly will get big drawdowns. We certainly will be lumpy. But the reasons for that is because of our particular approach to mitigating risk. We do it at the return stream or the trade level. The portfolio managers that apply dynamic position sizing, volatility targeting, they're looking at spatial adjustments based on the current correlations that exist spatially between return streams. But you must remember that there is a classic saying in this world where correlation does not necessarily imply causation. And this is strictly a phenomenon we find when we look at spatial correlations. And that's because the primary correlation, the reason for these correlations, spatial correlations existing, which is a secondary correlation, a derivative correlation, is because the primary correlation exists in the absolute momentum of a return stream. The price is the primary thing to follow. The absolute momentum is creating that price. So when we're looking at two highly correlated markets, we've got to look in an evolutionary perspective, in a time series manner, and then we can see the cause and effect that exists between those two separate markets. So a good example is, let's take the automobile industry. The automobile industry was initially driven by petroleum, gasoline. We then found that Tesla started making an electric car. It was still an automobile, but suddenly now we've got a correlation that exists between the automobile industry and the technological electrical industry. We've got an evolving relationship where the correlations are changing because different systems are interacting with that particular object as it evolves, at that return stream, as it evolves through time. You can see these relationships in a serial way along time, but you won't see them spatially. And so when people are applying risk management measures spatially, they're crossing their fingers, hoping that there is a cause and effect relationship between them reducing position sizes with dynamic position sizing or volatility targeting, or their use of cross-sectional methods for their trend following. But it's tied to a loose assumption that there is cause and effect in that relationship. It's not necessarily the case, because we can find highly correlated markets such as Brent and crude, or sugar and London sugar. They might be highly correlated over the course of time, but the small variations that exist spatially at any point in time can make them less correlated than they actually are, or the correlations can disappear because they're offsetting each other. So this is a problem faced in using these spatial methods, which is a legacy associated with economics, and they've got to move on to more modern, I think, methods of tackling these markets.
Hi, Maritz. How are you?
Hey, Jerry. Hi, everybody. I'm doing really well. I'm in Thailand, as Richard knows, because we've emailed, enjoying a family vacation, getting ready for dinner, and this is the good aperitif, I guess. Hey, on the topic of relative momentum, just like to add a couple of thoughts, and all of what I'm saying is just my experience or some of the probably still incomplete or surely still incomplete findings that I've gotten to over the last couple of years when it comes to relative momentum trading, or shall we say spread trading at the end of the day, because what you're really trading also is a spread. You're long one thing versus short another thing. So my thoughts and my findings around this are as follows. First of all, when you do this type of trading, my experience is that you're opening yourself up to more left-tailed events, and there's, I think, a reason for that. One is leverage. You're long one thing, you're short another. The returns cancel each other out to a certain extent, which means to get back to a certain, level of volatility, not talking about targeting anything, but, just getting your return or your volatility higher, you need to apply leverage. And, the more leverage you apply, every once in a while, things do go wrong, and that may hurt you. And this is something that we can see with a lot of the accidents that have happened, the largest blowups. I think if memory serves me well, spread trading was involved. LTCM trading spreads even in the same market, on the run versus off the run treasuries. Amaranth trading natural gas spreads. Remember was it 2008, summer 2008 quant quake, where you had all these factor exposures go south because the flows didn't stop? This is essentially long quality factor, long whatever the value factor, right? But in an extracted way. So you're long quality stocks, you're short something else against it. So every time you have these exposures and you use leverage, I think that left-tailed environment opens up because of the reason that you can be wrong on multiple fronts. When we trade our single market trend following system, there's a single source of being wrong, which is the price going against our position. We have an initial stop. We call it quits. We leave the position alone. We wait for another trade. That's it. Nothing more can really happen. But when we trade that spread, you can be wrong on both sides of that position. The position that you are short may actually go against you. The position that you're long may go against you, or the position that you're long may increase less in price than the position that you're short. So think about this example, right? You're in our single market case, single absolute momentum trend following case, we would never allow a position to move 50% against us. That just doesn't happen unless there's a gap. We'd be closing that position. There's an exit, there's an initial stop. But in a spread trade, you can have one leg of the trade go 50% against you and the other 51% in your favor. You're 1% up. It's kind of weird, right? That you're carrying a position that has lost 50% and you're still clinging to it. So this is just a precursor. So but I was so obsessed by this, so intrigued, that I spent not only days, but really months and years even of research into these cross-market spreads because of Quantica and all these other firms that apparently do it. All the markets divided by another market, all the markets, minus another market. It opens so many problems, rollovers and all that type of stuff. I thought that I had something when I used a co-integration measure, and I think there is something, but every time I looked, it had more of these left-tailed experiences that I would otherwise have in the single market trend following program, and I needed to use more leverage. The only space where I don't see this is in intra-market spreads. So this, you could say, okay, this is the LTCM thing, right? LTCM was an intra-market treasury type of spread to the large. They did other things with the Russian bonds and stuff that was their undoing as well, but a big position was their US treasury spreads. So I trade some of the calendar spreads, same market, So it can happen, of course, that even within the same market, you have a complete dislocation of the two legs, and one market or the front month or going up or down, and a longer dated month not moving or going the other direction. But it's far less likely. So you have less experience or less occurrences of these left-tailed experiences, and you can, in a way, use you can almost view this as a single market. This is the way I do it, with an initial stop and just trend follow it. And that puts you back into safe territory because, I have that initial stop on that spread, and once it's done, I get out. And if it doesn't, then it continues to go. But it's the same market. You can't really have this in any of the other spread environments. Like even when you do Coca-Cola versus Pepsi, yeah, it's supposed to be the same thing until it isn't. Until Pepsi, or like AMC. AMC used to be, I'm not even sure, a movie theater, and then it became a blockchain iced tea, whatever. Like these companies change. You don't know. So these spreads are risky, and I think the more time goes by, the less motivated I am to even revisit my research and look back into it. I think I'm on a much safer and better turf with the single market trend following that I do. It has less of a negative surprise risk. It is clearer in approach, easier to understand. I like easy things. And in the intra-market commodity calendar spreads, where it's the same market but just on a different point in time, yeah, there's something. At least I did find something, and I do trade that. And it has less of a risk of putting me out of business. So, yeah, those are my thoughts for that.
Yeah, I mean, I did something similar, and I agree with most of that. Although I will say that I'm never going to stop. Probably the same with you. We're going to go to cross trading traders anonymous together probably and get therapy, but because I don't think we can ever get rid of this idea. Primarily because I can't reconcile, or maybe I think I can a little bit. And this is what keeps me going. The idea that, my God, I mean, are you people looking at my positions? Uh, I don't know, but if you're not, you're missing out on some fun because have you seen how many currency cross trades I have on, how many positions I have on in two currencies that are not dollar related? So how am I doing this? Right. And yet, um, this is exactly what Moritz is talking about. And I'm doing it. A lot of people are doing it. The whole world is doing it. It has been doing it. And it is the same exact thing. No, it's not crude divided by heating oil or Coke divided by Pepsi, but it is the Swiss divided by the yen. And so perfectly great, perfectly fine. There are pluses and minuses, tremendous diversification. I've got a huge yen position, a huge China position that got crunched yesterday, but still huge profits, et cetera, et cetera. And so it's outrageous to think about doing that in any other market. No, I don't, not so fast. I don't think so. There's problems. Okay, Coke and Pepsi, crude and heating oil. I agree, but I can't intellectually move on totally. And I haven't noticed in my back test of this stuff the now we in this group we don't have to be so specific, but when outsiders are listening, left tail, see for managed futures, left tail is a bad day. A bad day in OJ yesterday. Left tail. Well, but it's a huge winning trade. Oh, well, I don't care. I don't care about trades. I'm looking at a daily dynamic position sizing, rebalancing, correlation, volatility, return based. And this is how I come up with ideas on what is an outlier, what is a left tail. It's a return. So for me, I can't have a left tail and OJ on this particular trade, regardless of what happens in a particular day. it's going to be a solid profit, if not a spectacular profit, right? So I have not seen
But
historically.
Jerry, just really quickly, that day yesterday would have been a day that the volatility targeters, the dynamic position sizes, the cross-sectional momentum methods would have taken action on that orange juice move. We don't take action because we are focused towards absolute momentum.
That's right. But what I was going to say is, I haven't seen in my back testing that even doing something like crude and heating oil and Coke and Pepsi, that I had left tail losing trades, where I could not get out of the trade without consistently on those trades without taking that small loss. And for me, which is 12 basis points. So giving back all the profit, having bad weeks and months and days, yes. But I I haven't seen any type of trading where it's so outrageous that I'm unable consistently to take that small loss. I guess it gaps against me or whatever. But I can't get away from this cross trading. I think the way that Moritz and I tried to tackle this problem, it's very frustrating and it is addictive. And and that's the reason I can't get away from it, is because I'm doing it in an accepted manner with my Swiss yen, sterling yen, Canada yen, Aussie yen, New
I don't think
Zealand yen.
it's a big trouble, Jerry, provided you're looking at a single return stream. With your models, you are applying a stop, a small bet, and a trailing stop, effectively, or your exit, which is confining the risk of that single return stream, whether you're trading a spread or not. Provided that return stream displays non-linear properties over the course of the long term, that's a valid return stream to me, at least.
Are you at dinner, Moritz? Do you want to comment on all of that?
Actually, I am about to head out for dinner. I'll be back with you. Let me just, I need to make some changes. I'll be back in 5 minutes for another 10.
Hey, can you hear me, guys?
Got you out.
Yes. Hi,
Right.
Alp.
Hello. Hey, Jerry. Hi, Richard. Hi, guys. So, sometimes, we, of course, we like what we do. So I'm a trend following trader for a reason. But because the conversation topic is about relative momentum, so first of all, relative momentum in the history of academic work, this piece of work has been documented and found as a market anomaly after the turtles. Okay, so that's a very important in terms of when it has been emerged. The turtles came first, momentum came after. So there's a time element like that. Second thing is there's a huge amount of academic research about momentum trading, relative momentum trading. So it has been documented as a proper market anomaly that works without getting into the details of how the strategy works. The relative momentum works to be able to, as an approach, to be able to make money. Now, there are certain things that are good with relative momentum. Okay, compared to the time series momentum, which I am doing. Now, relative momentum is easier and is more intuitive in many ways. Okay, now let's look into the what one of the hard things about time series momentum while trading stocks is, of course, it is a fixed portfolio. Yeah, it has taken months for me, thanks to Jerry Parker's guidance. I mean, if it wouldn't have been him, I wouldn't have done it. It has been very difficult for me to get my head around to trade fixed portfolio of stocks, you know, because in relative momentum, you never trade a fixed portfolio. You order them by, if you're taking 100-day breakout, you use a rate of change of 100 days to be able to order the same stocks in your portfolio. Let's say you're keeping an eye on Russell 2000. So you order Russell 2000 by the rate of change of 100. and see which ones are actually having a higher momentum, higher relative momentum, and go long for those, right?
Okay,
Isn't
if
it?
I could just interject there. Thank you so much.
Sure.
That's perfect. I mean, exactly. If you're not trading a fixed portfolio, going to have problems with trend following, and they're not trading a fixed portfolio. You know, honestly, just to interject before I'm going to let Al keep going. You know, the problem here under one heading, it's dynamic. Anything that's dynamic and changing, the the back test can deal with it. It'll just go out and find the perfect parameter. But it's the disaster going forward because too many things are changing. Um, this is the lie of the back test. You can make the back test with dynamic elements so wonderful because the computer is so powerful, and you just re-update it every year with more data, and you're refining that historical back test. There's no way to make one entry, one exit, and a breakout very good. It just won't get too much better. Uh, Not like a more dynamic approach. And by this one fact, amongst other that they don't keep consistent, is without this fixed portfolio, there's no way that the future is going to look very good. It will not work. Keep going, Al. Sorry.
Oh, no. Thanks, Jerry. I mean, the whole point is for the beginner's eyes, okay, it is easier because the more intuitive approach, if you are not a time series momentum trader, a trend following trader like I do, okay, and many other participants in this club. So it takes sacrifice, it takes time to be able to be able to perform like this. It's harder. It's a style that has come before momentum, and of course, when momentum has been invented towards the beginning of 1990s, when it has been found and documented, you know, this dynamic approach to trade stocks is easier. Okay, so the portfolio is not fixed; it is dynamic, and it makes a lot of intuitive sense on the beginner trader's mind. Okay, because you want to be trading the leading stocks, and trading leading stocks is what some of the best traders does, like Mark Minervini, for instance. Okay, so if you read Mark Minervini's book like I did, you will notice that he actually talks about the leading stocks and the leading stocks and the leading stocks and the leading stocks and the leading stocks. Okay, so the leading stocks is a nice way of saying relative momentum, and and it works. Mark Minervini combines time series momentum with relative momentum, with the idea of this leading stock, and it just makes wonders. The guy is making a lot of money out of it. How can we say that it is not working? It is working. So there is that element. Okay, so it is easier because the portfolio is not fixed. It's easier on the beginner's mind. The second of all is, this relative momentum strategy doesn't trade all the asset classes like I do. So I'm making a huge effort, and I have made a huge effort in my, you know, I'm an average guy on the street who decided to trade classic trend following, all right? And I made a huge effort to be able to understand how bonds work, and then how forex work, and then how commodities work. So there's a huge effort to be able to trade all these asset classes. So it's another layer of complexity there for you. So it's not only the stock portfolio is fixed, but you have to trade all those four asset classes. And in relative momentum, you don't have that either. So it's one single asset class. You're gonna trade stocks, you're gonna make money, easy days. And if you're a new trader that you have been, learning your craft, so it's easier. It's simple, it's easier. All right, what else? Well, I'm a short-term trader, so I'm trading minutes, any minutes, like 15 minutes, 30 minutes, hourly bars. You know, I'm breaking down basically in one day. There is 1,400 minutes. I'm breaking it down minute by minute to be able to create systems. So I've created many systems like that, and so this takes a lot of technology to do. All right, to be able to trade minute bars require a lot of technology to do. And to be able to trade relative momentum, you don't actually need to have a lot of technology as well. So it is easier on the technology side. It is easier on the mind because you don't have the fixed portfolio. You have the this turning portfolio. Also, you don't have to trade bonds for God's sake, for a new trader, or for forex. Oh God's sake, you can only trade stocks and make money out of it. Can you imagine how simple is that? And of course, there are some excellent traders who are doing a lot of money with just trading stocks. Like Mark Minervini is one of them. All right. And it has been documented by academics and whatnot. So the lineage goes back to 1990s. So relative momentum, you like it? Great. Am I doing it? No, I don't do it. It's because it's even though there are certain advantages, there is always the complexities that I have just mentioned with the trend following actually makes it a more robust system, and there's a bigger match for my personality. So I've been trained this way because classic trend following is there is something else more unique about trading this diverse portfolio, to be able to go to the mathematical expectation of each market. Can you imagine, they are trading Apple when Apple is making money, and then turning into the Microsoft when Microsoft is making money, and then turning into the Coke when Coke is making money. So it's a different game. Does it work? Yeah. Oh yeah, it definitely works, especially in the quant space, like which I belong to myself. I would say all of my friends are trading relative momentum first, because it's easier to code, you make good amount of money, you only trade stocks. Oh yeah, you know, and it works. Thanks a lot.
But Alp, the only thing is they won't understand what an outlier is. They'll be catching a different form of trend. So, with orange juice, for instance, I've been writing orange juice since 2020. For 3 years, I've been writing orange juice. And if you were looking at things spatially using relative momentum, you might have been in and out of orange juice 20 times over that 3-year period. You'd have also been substituting for sugar. You'd have been substituting for other commodities. You'd have been substituting for other high sort of relative strength trend components. And when you put that all together at the end of the exercise, you're not catching an outlier that we're catching. You're not catching the full extent of orange juice because there's been predictable assumptions embedded in that method, and there's been rebalancing going on in a month's time. A month's time, we might have had no movement of orange juice, or a month's time, we might have had an explosion in absolute terms. And they're not picking that necessarily up with their method. So I recognise there's an edge with their method, but it is certainly not outliers. And, so this is where we need to set ourselves apart from this other form of method of trend following and call it as it is. We are outlier hunters.
Yes, but just look, as you understand, I'm a little bit playing the devil's advocate here, so I'm purposefully being obnoxious with my comments. That's not how I trade, but just to
I
make
know,
the
Alp.
conversation interesting, But now, when you look into the, when you read Mark Minervini's book, I think if you haven't read it, go read that book. So you read a great relative momentum trader's trading style, okay? And he brags on this leading stocks idea, okay? Of course they catch those outliers, Richard. This is what they call these leading stocks, okay? These leading stocks. So these guys, just order. So there's an idea of ordering stuff. So when you order these stocks and orange juice, these are different animals, as you know. Majority of these relative momentum traders do not trade commodities. So if you park the commodities and just focus on stocks just give you those outliers like months. Like bull market can last a year, 12 months easily, sometimes more. And with that sort of an understanding, of course they catch their outliers. However, it's a different animal. So I always figured that, you know, it is very popular in my among my friends. Just, and among myself, there are lots of new traders like myself. So this is my second year in trading. Jerry Parker is trading for 40 years, so listeners can gauge the level of experience there. Um, and it's very popular because it's easy to implement, and this leading stocks can give you a lot of money as well. And are there outliers? Oh yeah, big time there are outliers. How can you tell that they are not outliers when you catch an apple going up, when you order them, and when as a result of your ordering, if that stock is going up, oh yeah, happy days. Thanks a lot.
Hi, Richard. Can I ask you a question? Do you think that short-term trend following kind of gets the same or a similar result of like relative momentum, meaning that it's kind of the universe, it's not that the universe is changing, but the positions change so much that it ends up being some kind of a relative strength result. I mean, not philosophically, because I know it's the same with different parameters, but the result of having short-term parameters end up being like something like a relative rat race between your price signals.
Yeah, look, you'd need to ask Alp because he's a specialist here. But from my experience and my research, you can trade trend following on short-term models, but my selection process disregards them because the volatility of them is much more extreme than the volatility I'm getting of my medium to long-term models. And so an example is that during a particular regime, the short-term models might scream ahead, but on balance, over long-term data sets, over many, many regimes, I just find they're too volatile. And so because I'm using a part-dependent metric in my selection process, which is the MAR ratio, they naturally get excluded from my selection process. And this concept of part dependence, which is so critical, is something that we practice heavily in absolute momentum terms, and we recognise it as a structural means of mitigating adverse risk with our stops and trailing stops. But this part-dependent property, we are deliberately taking action to try and get the most asymmetrical sort of outcome from the long-term data sets using these structural means. And yet, when you look at things, say, cross-sectionally, they're using other risk mitigation methods, which I don't think are as efficient as our methods. And they say we're simple, but there's a good reason for the simplicity of what we're trying to do. We're trying to enforce this asymmetry. Moritz just a moment ago talked about co-integration. And effectively, what these structural methods that we're applying with our risk management methods is a form of co-integration as opposed to using correlations as a way to mitigate risk. We are enforcing a design constraint into our models, which forces this asymmetry into the outcome, which means that if we are applying an asymmetric model, an enforced designed asymmetrical model into an asymmetrical system, which we believe these markets are, we believe that the net result is the best we can get, as opposed to forcing a linear model into an asymmetrical environment, which is a result that, say, cross-sectional gets. Now, the short-term guys, they are doing what we're doing. They are absolute. But Alp will need to tell you he will definitely need more bells and whistles on his models if he wants to overcome that inherent volatility, lumpiness that exists in the short-term models. And I don't know what Alp does. I'd love to know what he does and get under his hood, but he'll have to tell us.
Yeah. Sorry, I was thinking. I was thinking. I didn't thought of up. I was thinking more, like original, shorter term things, like the original Tartars or Toby Crable, etc. But of course, Alp is an extreme of that, I think.
Yeah, look, EMC, I was just posted up EMC's podcast with Niels. They were, part of the Turtle Trader clan with the lady, Liz Cheval, who has passed away, and they've continued on the tradition, but they have started implementing these, what I'm calling these spatial measures to mitigate risk. So they're a slightly different form from their original form that they took in the turtle trading school. And things such as, links and things such as, our friend Nigel Coolajan, they're different models, definitely different models to our models, so they're getting different outcomes. So, I think that cross-sectional methods, they definitely can demonstrate that they can get a smoother equity curve than we can, but I severely question their ability to give the lifting power that our absolute momentum models do over the very long term. They're definitely smoother, but I think we've got it over them, recognising that we will be lumpy, but we have this lifting power, which is this path-dependent property that exists with these endogenous events that lies within the return streams themselves, as opposed to the majority of markets' focus, which is on exogenous factors such as news events, relative strength to other markets, correlation properties to other markets. They're not looking within the return stream itself and within the market itself. And that's where the secret, I think, to our success lies, in these chaotic properties that exist in the markets themselves.
So what happens is, when you look into the shorter models, I see the difference. One of the differences is like industrial revolution of the 16th century. You had this merchants and the tailors who were doing these trades, tailoring one by one, and then the industrial revolution has come and they basically automated it, and so that you were able to sell the same products thousands times more. And it's a little bit short-term trading is like that. When you're trading, 15-minute bars, which works like wonders, 30-minute bars, 60-minute bars, any minute bar. Okay, so the whole idea is you have to do it faster. First of all, the speed is going to be there, and so there is an idea of industrial revolution in there. Okay, so you're not taking those trades by hand, and you're taking it by the machine. So your edge could be smaller, but surely you can do a lot of trades so long as the costs allow you to do that. And in the last decade or two, costs have come down significantly. All right, so that's the main thing. So in one day there is 1,440 minutes. Okay, so I keep on saying that. So if you come down to from 1,400 minutes, so if you come to the 1,300 minutes, and if you apply the same model, it's going to work. Is it possible that something that works on the 1,400 minutes level, but it doesn't work on a 1,300 minutes level? Is it ever possible? No, it's not. It's still hugely long term. 1,400 is very long term. But what happens is you have to take your thinking on a minute by minute database level, okay? And to be able to do those things, of course, you have to use a 5-minute database, like I do. So I do my work from a 5-minute database, and when you apply your thinking to that level, all right, and so things are, of course, you're going to increase your number of trades. So that's number one. So yeah. So if Richard takes his models and applies into the 5 minutes realm, and then if he trades the same system from a 5 minutes perspective, okay, so you should be able to come to the same result. First of all, I think that would be the first task of anyone who would like to trade minute bars, right? If you're trading daily bars, apply a database with 5-minute bars, and then consolidate those 5-minute bars into daily bars, and consolidate them into 1,440 minutes level, and see whether it's going to work. Of course it will, right? Because it's the same thing. And then logically, it's not it's only intuitive that if 1400s work, then 1300s will work, 1200s will work, 1100s will work. But you will need a data scientist to be able to take care of your 5-minute database, and then you need speed, you need better algorithms, better developer, better technology all over. Okay. Now, the second thing is, if we go back to the Nicole Collagen system, and basically, I was running a very similar system last year myself. So he basically said that's a 5 days breakout. Okay, so you consolidate those 5-minute bars into single digit breakouts, like a day or 2 days, 3 days, 4 days, 5 days. Okay, but you only take the trades in line with the main trend. So so you have a threshold at the high level. Say, what is my long-term system? My long-term system takes 200 days. Okay, then I'm going to enter into those 5-day breakouts so long as I am the long-term trend exists, but I'm going to piecemeal that long-term trade into bits and pieces so that I'm always taking my shorter-term breakouts in line with the long-term. As a result, your number of trades that you're taking happens to be in multiples of thousands, and there are managers who does this sort of work, like Niederhofer, for instance. Niederhofer trades like around 10,000 trades per year with some of its strategies. So it's all about using a better technology, and you don't have to take, as I said, you don't have to take all of these 5-day breakouts. You can only take them when those breakouts are in line with the main trend. And if you have a technology to do that, it just works. How could it be? And if you have any skeptical of this, your first starting point is always what I said. You have to have a database, 5 minutes, then consolidate those 5 minutes bars into 1440 minutes, and then you should be able to get exactly the same result as the long term, and then start reducing it. Start reducing those minutes one by one, and then your trade numbers are going to increase slightly a little bit, but still you are going to be hugely long term, and results are not going to change. But the whole idea is to use those minute bars into your trading philosophy, and there's always going to be an element of speed. In the past, you didn't have the speed, you didn't have the technology, you didn't have the industrial revolution working for you. Now, the idea of industrial revolution is working for you. So this means that, someone else like me, I'm a sole trader, right? I'm trading on my own. I can take 10,000 trades without even, blinking. I really don't care. Why? Because my systems are taking those trades in an automated fashion. Why do I care? Do I need to have as a big team, like, any other CTH? No. I'm full automated. I really don't care if I'm taking 20,000 trades, so long as my technology works. Well, the question is, who's willing to do the work? If you do the work, you'll get there. Thanks a lot.
And
Thanks for that, Al.
Thanks.
I want to say such an important thing that we must understand our risk management here, and I have said this before. It's my own research, my own experience. That it's when you risk, for example, 1% in a trade, when you trade 200-day breakout, it isn't the same risk if you trade, for example, 5-day breakout. So, of course, we can do a back test, short, maybe term back test, maybe few month back test, and see that, for example, 100-day breakout had a performance, for example, 10%, and 5-day breakout with risk 1% have a performance 30%, for example, on a market, but you will have a drawdown 3 or 4 times, maybe bigger average drawdown. I'm not talking now about extreme drawdowns. I'm talking about the average drawdowns, and of course, extreme drawdowns I think also can be bigger. So The main important thing that in a short-term space, our risk must be, I think, 2, 3, or maybe 4 times, depending on what short you are, how short you are, less. And so, even in that situation, we can say about the same expectations, the same results. So, when we have 4 times less in a short-term space, and when we have 4 times more in a long-term space. It's my point here. It's not the same risk, I mean.
By the way, Richard, can you name that paper that you talked about, the endogenous factors of momentum in time series?
Yeah, that was Jean-Philippe Bouchard. I think it was called the microstructural studies of price data. So just look up Jean-Philippe Bouchard, and he's got a series of white papers. And also, if you look at Niels's website, some of the blog posts referred to it. I remember writing something about it for Niels. You'll find the link to the white paper there.
Thank you.
Yeah, that was fascinating stuff. Very comforting as well, in that 90% of all the trends come from endogenous factors. And then, back in the old turtle days, turtle training, there was sort of a recognition of this idea that the trends in markets should be somewhat mysterious when they first begin. And then over time, this information kind of comes out as to why these fundamentals are happening, and that are generated this trend that started months and months ago. And that we were sort of told that if you start hearing too many reasons for this trend after you've been in the trade for a while, then you should be very nervous about this and maybe plan to exit a bit sooner than the trend would indicate. And this is similar in the sense that when these trends come out, these exogenous type trends come out, that immediately the news is there telling us exactly why this is happening. Those are the 10% of trends that he identifies as, and then they're kind of like short-lived to some degree. The news is out. There's no delay of this information. A lot of people, I like this kind of explanation. Some people are obsessed with why do trend following work. I'm not really obsessed with it. But I do like this idea that this one seems more reasonable to me, that over time, less information dribbles out over time and people are slow to react to it. Thus, the trends happen and are significant and can last for months and months.
Yeah, Jerry, you see this in nature all the time, earthquake events, so there's this internal pressure building up, which none of us see, none of us are aware of, and then there's a slight strike-slip fault that's created from that pressure build-up, and suddenly it causes this catastrophic changes to the system with earthquakes, tsunamis, etc. We find this in avalanches where the thing that's holding it all together, the turbidity in that system, suddenly just slightly gets less by the inclusion of water into that structure that's holding it together, and the entire mountainside gives way, and you get these massive change events. These are all sort of these endogenous features that occur in systems that are perched well away from equilibrium, where you get these endogenous factors, very small factors or slight changes to the system structure, which creates this landslide, this massive change event, so that system never restores itself to that prior state. It goes down to a new level of equilibrium over a period of time where the system is totally changed. The new species flourish in that new system. Prior species are totally extinguished. And you see this in the market when you're drawing analogies with the market. You see, over a period of 10 years where people assume that the S&P 500 is always going to go up, of course, everyone flocks to that, and you get this massive increase in the population of traders that are betting on that proposition that the S&P 500 will continue to go up. But then when the S&P has this endogenous change, and suddenly that predictive, that predictive tendency that everyone was holding on to so dearly is gone now, and that the prior species gets extinguished. But the trend follower just survives through all of this. It's a tale of robustness. It's not a tale of occasional sort of species sort of exploding in population numbers. Go to Moritz and talk about his Takahi bird.
I love in these examples that I love this theory, this research about endogenous events. And all the science, math, and maybe even biology and physics shows that we are on the right path, because really it's the evidence that endogenous events, if you study science, you understand that idea with endogenous events is great. So it's a very good evidence for me personally. And also that this idea of concentrated bets in prediction models is a very bad idea. That sooner or later, according to the science, according to the universal laws of nature that we know, sooner or later it will be very big losses if you have concentrated bets and it's based on your narrative, on your idea. It's not a good foundation. Good foundation, it's, as I have said many times, it's universal laws, it's a great foundation. And if you see that it works in nature, if you see that it works in biology, if you see, it's a very, very, very great evidence for me, personally at least.
One thing I want to bring up too is I'm going to maintain my heartlessness as it relates to not agreeing too much. I want to be the last person that ends up agreeing that there's multiple ways of doing things, multiple right ways of doing things. Our way is one way. Well, Richard did say our way is the best way. And so I guess I'm more along the camp that to a large degree, our way is the only way. It's the only safe way. And then just because it hasn't blown up in your face yet, whatever you're doing or I'm doing, doesn't mean it's not going to. And so you can go long periods of time doing risky things. I've done it before, and then it blew up in my face in 2007, 9, and I had to realize I was making big mistakes, risk management wise. And so, another thing that happens is these people this week, they're onto this idea of criticizing me on Twitter or making comments. And this one guy, super nasty, he didn't mention my name, but he just started saying, quoting me basically. And somebody on Twitter said, "Hey, quit making fun of Jerry." This guy's super nasty and super rude. And so, so I'm going to start doing the same. And, then some people say, "Oh, my friend, my trend following friend." So I'm going to start saying that as well. So one of my trend following friends, he frequently says, when I look at the performance, I don't see much of a difference between dynamic position sizing and those who don't dynamic position size. And so I've obviously made the point that I know of 5 people in the world who don't dynamic position size that trend follow and that use trend following. And so they're usually not the ones you compare anybody to. And then recently, my friend said, in looking at the StockGen 20 or the largest traders, the largest CTAs, when I look at them, I don't see much difference between any of the performance. Yeah, because they all dynamic position size. What are you doing? They all dynamic position size. The whole industry dynamic position sizes with correlation and volatility. And it's way more complicated than that, or how I would even envision it. By listening to the CTA series on Top Traders Unplugged, it was unanimous that you can't even be a proper CTA, managed futures CTA, without dynamic position sizing to some degree. No one is letting orange juice run. No one is willing to wait for orange juice to have meaningful drawdown that the back test would say now is a good time to get out. If you're interested in maximizing your terminal wealth, then you have to wait a long time before you can get out of this trade, and it's going to be subject to give back. No one does that except 5 people I know about. Me, Richard, Mike Melosinos, Moritz, and
Mulvaney.
Yeah. Okay. So who's the 6th one? Okay. Not counting people on this podcast and others who are anonymous. You better be anonymous or you're not going to get any assets under management. So there is nothing to compare to. It's a false comparison. So, the whole problem that I see with all of this is that trend following is so powerful and so wonderful, and diversification is so great that you can do a lot of things that are suboptimal, that are not great. Unfortunately, especially on the risk side, that's going to bite you in the ass down the road sometime. And trend following, because you're doing it, because you're paying attention to prices and trends, and you're diversifying and taking small losses, you can survive and you can prosper. And it looks like everything's going great until it doesn't go great. And that's what Richard was saying. Like, Sharpe ratio is a false indicator because it all goes great for the people with high Sharpes until it doesn't go great.
Woody, loved your contributions in LinkedIn, mate.
Hi all, can you hear me?
Yes.
Gotcha.
Yeah, hi, this is Marcus from Estonia, Europe. I haven't participated much since the move from Clubhouse to Twitter Spaces, but I've been listening to the recordings, so always high quality stuff, so thank you for that. I just wanted to share my reason for using relative strength, especially in stocks. I mean, actually in stocks and mostly on the long side. It just helps me to remove the selection bias, if you know what I mean. I'm I won't argue with your decades of long experience. Like, I have 6 years of trading experience. I trade my own money, $500,000. So the thing is that what I see with relative strength tied to absolute momentum is that I always get into the high flyers, at least many of them, before they get to the news. I mean, like Meta and Nvidia this year, or energy stocks last year, or tech prior to that, or Tesla in 2020. It always keeps me in those high flyer names. So but I'm not a pure classical trend follower. I'm a systematic trader. I do the relative strength in a systematized way. It's very simple and robust, long term. And just wanted to share that because I've learned a lot from these spaces. And I'm a fan of Jerry Parker, and also started to like all the content from others here, like Richard Alp, Absolute, and others. So good stuff. But yeah, I don't need to defend relative strength. I don't need to argue about it. I just do what has been working well for me. Thank you.
Yeah, I think if I understand this selection bias, it keeps coming up, and so I'm very interested in it. I think that if you select your stocks, like I do, just to maximize the diversification, no back test, no cherry picking the stocks, and you keep it a fixed universe forever and ever, all the markets, currencies, commodities, interest rates, and stocks. Some markets go away, of course. And then I expand my portfolio and reduce the relative size for each of the positions when I do that. But I think that this fixed universe is a unique situation. And I'm always, I think it's kind of funny because I read all of these hedge fund articles about chasing NVIDIA and chasing the next hot sector, and trying to find those sectors. We got to find the next big mover. And I'm sitting there like, No, I've got my fixed universe. And if it's not in there, I'm not going, and then the 72 stocks that were responsible for all the profits. This is the problem. We're playing this trend following game, and people who are in the game get upset with me when I explain further elements of my game. Can you imagine how some people would say, you can't make money following these trends? That's not even real. It's a game you're playing. Why don't you understand balance sheets and income statements and what's coming next for the world and America and AI and how fun this is? And then they're like, no, we're going to do this trend thing. But when I add an element of gamesmanship to it, that an algorithm has said, hey, this could be an edge for you, it offends people. This fixed universe or letting profits run or, oh my God, what is the thing that offends people more than anything? Sit down now. Absolute. I get more shit from people because my backtest algorithm tells me to separate open trade equity with closed trade equity. Holy smokes. You would think that guy who cursed me out this week, that's the dumbest damn thing he's ever seen in his entire life. Holy smokes, how offensive. That
I thought he was having a go at me, Jerry. I know the one you mean.
That fucks up people so much. They cannot get over it. That is the litmus test that is the one thing that is evidence that I don't have to pay attention to Jerry Parker. The one thing. And that is
that same bloke has invested $1 million in Mulvaney. How can he say what he's saying when he's heavily invested in Mulvaney?
Well, not to get too distracted on him, but I searched out and found this guy because, like most cowards on Twitter, they don't use their real name. He uses his real name, but you have to sort of dig to find this guy. And he's just not being outrageous to you or me. I would have, it could have been you, but someone on the Twitter thread said it was me. But okay, back to where I was going with this. So this, fixed universe. And so I think it's just a game, and we're not participating in the real world. We're not participating in what the world is really doing. And we're just following these stupid trends, and it's a game to us. So when we have this fixed universe, and when we and then these 72 stocks that make all this money, and they're the only ones that made the money, and so few stocks on a buy and hold are responsible for all the profits. The thing of it is that all 500 of those S&P stocks over time will have trends, and they had trends. It wasn't just the 72 that had outlier trends. The problem is the outlier trends weren't captured. Randomly holding something and never getting out, hell, you even get 72 of those, which I think is kind of remarkable. I'm surprised any of them made any money with no exit, but almost every single one of those stocks in that stock universe, in any stock universe, is going to have massive trends. And with a trailing stop, you would have gotten out with a nice profit. So I have traded these. I have not traded a fixed universe before and continue to add markets and stocks to my portfolio and trying to find the strong movers and the latest and greatest. And it's just a situation where I got crushed because you're continuing to buy and buy and buy, and then you're not allowing yourself to have this flat period and this short period and sort of the way the trend following all plays out, where you're slowly moving your exposure up and down based upon the trends. And it's very dangerous to have like this unlimited supply of equities, and I'm always just buying new breakouts. And that happened to me in 2000. Unfortunately, it happened to me in 2001, where I was doing something stupid like that and just continuing to buy these breakouts and making sure I was loaded up in equities right before 9/11. So it was a really painful period. These are all elements of classic trend following. Was the trade level calculation, the fixed universe, one entry, one exit, and a stop loss, and eliminating any one of these, or I just think it's very dangerous. I can't tell you which one it's that if you ignore it and don't pay attention to it, that you'll be fine. Oh, I'll be fine. I'm fine. It doesn't matter how we do it. This is dangerous talk. This is dangerous ways of thinking, and that all of these elements are critical. You know, you're building a portfolio like building a building. What part of traditional classic architecture and engineering do you want to leave out of this building? Well, it's okay. We don't have to do that. No, it's in the books. You should probably definitely do it because there's hurricanes and earthquakes, and these things would not be in the book of what is a proper way to build a building from an engineering point of view if it wasn't necessary. So people build buildings all the time that don't have all these qualities, and some of them last forever, I'm sure.
So one of the, so there are lots of things that are non-intuitive with this. Jerry Parker's pearl of wisdom, actually. I 100% agree with this wisdom. However, it's so difficult for a lot of people. I mean, there are many things that are not very difficult, but I think one of the most difficult parts is this fixed portfolio, which leads to huge elements of selection bias. Now, within quant community, where everyone else is so obsessed with quantification of everything else, basically what Jerry Parker is saying, and which also I'm doing in my own trading, is I'm trading a fixed set of stocks. So I'm trading 75 long and 75 short stocks, like around 150 stocks, half of them long and half of them short, but they are fixed, okay? So in my own trading, basically, I am ending up a huge element of selection bias. So there are 11 sectors within S&P. Those 75 has been equally distributed into those sectors. Okay, but there's a huge amount of selection bias, and a lot of people who are doing this relative momentum, like Marcus was mentioning a moment ago, when you're trading 100-day breakouts, and if you're using a rate of change of hundreds to be able to order those stocks, you are mathematically eliminating this selection bias. Okay, so there's a method to address that selection bias, because everywhere, wherever you look into it, if you Google it, if you read books about it, everyone else is talking about selection bias. Okay, Jerry Parker is the only person that I've ever heard who says you have to live with the selection bias. Forget about the selection bias. And I
Yeah,
love
I've got an issue. I've got an issue there, Alp, because Jerry's trading 300 markets as a fixed portfolio currently. That's what he's trading now. A relative momentum guy might be trading 60 markets, 80 markets. So, so this is how I see relative momentum or rotational strategies in this relative momentum space. They're looking at a snapshot in time, and they're looking at the relative performance of their return streams and ranking them. And then they're not applying stops in their models. What they're doing is they're selecting maybe the top 10 performers and the bottom 10 performers if they're long and short, or they might just be long only, looking at the top 10 performers. They're waiting for the rebalance, which could be any term, but let's say it's a monthly rebalance. And then at that particular point in time, they're taking another snapshot at that point in time to determine the relative strength position, which therefore changes the composition of their portfolios. We don't have that monthly lag between the rebalance period, and we also use stops. We're trading a return stream to its conclusion. We're not I've got no doubt these rotational strategies will pick up the strongest performers, be able to jump onto Nvidia, be able to jump onto Tesla, etc., because that method actually produces that result. But where I think the weakness lies is they don't hold those positions. They get out prematurely based on their rotational, their monthly rebalance, what the assessment is doing with that cross-sectional state at that particular point in time, and they make a decision at that point in time. Okay, I'm going to change over to this market now and get out of that market because that's now no longer trending. But in everything I see with this path dependency is under path dependency, the longer you hold something between entry to exit, the more you benefit from the path dependent nature of return streams. The more you tighten the distance between your entry and your exit, the less you are relying on path dependency and the more you're relying on spatial statistics.
So, yeah, actually, I agree. So one of the benefits of classic trend following over momentum is, now momentum has been documented to say that if you trade stocks that are going up in the last 12 months, okay, and you can actually form a strategy to make 6 months, 12 months, 18 months, 24 months, okay, and if you go long for those ones, now, okay, so you're catching all the hot stocks, but what the problem, the drawback is, you already lost 12 months of performance. The fixed portfolio and the trend following, the classic trend following, never, you are catching the 100%. You're catching the first 12 months of performance with classic trend following. That's key. And in relative momentum, you're leaving it on the table, and you're saying that, okay, so this stock has made a very good return for the last 12 months, so I should trade that in the second 12 months. So you expect a better result in the second 12 months with relative momentum, but classic trend followers say, all right, I'm trading this, so you can actually get the benefit of the first 12 months as well as the second 12 months if that stock goes well. So that's the positive side of classic trend following. And so you have that advantage. So when I trade, I would like to get the advantage of the first 12 months and the second 12 months because I am not leaving any returns on the table. However, what I'm doing is I am ending up with a selection bias. So for instance, this year in my own trading, I haven't incorporated these big names, which turns out to be a sour example for myself. So I would have, if I would have incorporated the Fang Plus components, obviously they made a lot of money, but it's lesson learned. So but there are always going to be things that are missing out because of that selection bias. So it's never a perfect portfolio. So the only fix is what Jerry Parker is talking about. You have to trade this damn thing for many years for you to be able to get back to that mathematical expectation. And that's the beauty of it. If you do it over the long run, you're going to catch that mathematical expectation. And one thing that makes classic trend trading better than relative momentum is you're not leaving that 12 months of return on the table. They are just watching it to materialize, these relative momentum guys like Marcus, okay? And then they are entering into it. So that's a big difference. Thanks a lot.
Well, that's one of the things that I was thinking that Richard said, that I don't have 150 stocks in my portfolio. I maybe have like 20, 30 because I obviously don't have as much money as Jerry Parker does. So it's very hard for me to have a fixed universe of 30 stocks. Then the selection risk becomes so much higher. And if I was trading 150 stocks with my AUM, with my money, then it would be much more efficient for me to just trade the QQQ Nasdaq index or even the S&P 500 index, because 150 stocks, all the fees, slippages, the positions would be so microscopic that it wouldn't make financial sense. But yeah, I think it just depends on the trader, the profile, and AUM, and all that kind of stuff. But yeah.
I agree, Marcus. That's this uneven playing field. None of us have the capital of Jerry Parker, which makes us have to do things that we might have a different approach for because we have a much smaller finite capital.
Well, I would say that I don't agree with any of that. So, I mean, I don't want to discourage you from doing what you're doing, and I appreciate you calling in from Estonia. Please come back. But I don't agree with any of that because my teenage son, when he started trading, he traded less than 20 stocks. And there is no um, selection risk. Well, okay, there is selection risk, but not really in the sense that we've already established that all of the markets that you trade, whether it's the S&P 500 or whether it's all 500, long, short, flat, using trend following, or you have a limited number of markets. Well, there's really, if you're trading equities and ETFs, you can trade hundreds of markets because you can trade them. You can trade one lots, which you can't really do in futures. But anyways, there's no per se selection bias or selection risk because if you trade all 500 or 5,000 stocks, or if you trade 20 futures like I used to do in 1984, 85, 86, and 87, and then in 88 when I started Chesapeake, I started trading maybe 50 markets because all of those markets are going to have trends. Not on a buy and hold basis, but when you overlay trend following to them, they're all going to have trends. I was making 200% a year in 84, 85, 86, and 87 by trading 20 some markets. So now there were other markets that were not in my portfolio that were doing well. And I would have made those if they'd have been in my portfolio, but I wasn't trading them. I didn't get the losses in those markets in some years either. And I didn't get the big trends, but I got the trends that were in my 20. I get the trends that are in my 300. And whoever said, and I agree with Niels in this regard, if you trade 300 markets, classic trend following, you're going to make about the same amount of money as if you trade 50 markets, classic trend following. It's going to look different over the years. It's going to be bumpier with the 50 markets, but you're going to get this over a 20 or 30 year period, the same amount of trends in those 50. You're going to get proportionally the same amount. So there is no risk of choosing the wrong markets, not with trend following.
I've got to admit, I disagree with that, Jerry.
Oh, good. Well, finally, we found something we disagree about. But yeah, so that's, but certainly with stocks and buy and hold, you better buy the S&P index or buy an index that's going to contain a lot of stocks, all the stocks, so you don't miss out. But like I said earlier, if you trend follow those 500 stocks individually, then all of those stocks will have trends over time and will have outliers. And you'll capture those with trend following and not be stuck with whatever you get that and have to rely upon has happened in the past. I don't think it's as good to rely upon the historical returns of the S&P. That's not as safe as relying upon the historical returns of a systematic trend program that has thousands and thousands of trades, a sample size of trades. Go ahead, Richard.
No, look, it just cuts against the grain of maximum diversification. So I'm in the camp that theoretically you go as far as you possibly can with as small of possible bets as you can, because we're hunting these outliers, and we can demonstrate with the non-linear nature of these outliers that the greater proportional representation you have with greater diversification, the greater the non-linear impact in your performance over the long term. So that's where I disagree that trading 50 markets over the long term whilst being lumpier than 300 or 400 or 500 markets. I actually think the performance improves with 300, 400, 500 markets.
Oh, I agree. It improves because it's the perfect type of it's the only acceptable way to achieve smoothness is with trading more and more markets. You can't get more in love with diversification than I am. Although maybe we both of us would agree that once I got to 300, now I'm thinking, I got to get to 400. And then once I listen to Floor and Court, I've got to get to 500. So I'm trying to figure out a way to do that. But a lot of that depends upon AUM growth as well, because I agree with all the things you've said about small bet size and compounding and smoothing
one of
things
the
out.
things with outliers is that they're not evenly distributed throughout the distribution of all markets. They're incredibly exotic features, anomalies that are not evenly distributed. In fact, they can cluster a lot of the time. And so being that they are not evenly distributed, but they are nonlinear features, there is no such concept as 1 divided by n in our outlier world, which is a typical excuse used by those people when they say there's a level of maximal diversification to achieve where there's just a small marginal benefit if you go any further than that. In this world of these outliers,
explain that in terms of the things that I think we both have said before. I know I've said it, in the sense that, let's say, it looks like that when you start adding more and more markets, this I think you said 13% recently, 10%, 13% of the trades will be outliers, and you can multiply. This is something, quote, who continue to forget that as we diversify more and we reduce our bet size proportionally, or slightly less than proportionally, because you can trade larger, overall, your risk budget can be higher if the more markets you trade. Let's say you can't go crazy with that, but marginally a little bit higher, let's say. But you apply this 10% and 13% to, and you see that if it's 50 markets or 500 markets, 10%, 13% range is going to play out. Then explain the benefit then, beyond compounding and having these trends, these outliers spread out more in the data and not being clustered as much. Explain this other thing. I think you're saying is this other benefit that I'm missing.
So, look, I've put up previously on Twitter some hypothetical portfolios, a portfolio of 5 markets, a portfolio of 10 markets, a portfolio of 20 markets, a portfolio of 40 markets. You can keep on sort of going up to 100 markets, 300 markets, or whatever. Now, when you look at the portfolio results and you do this, say, for instance, we've got a total possible universe of 300 markets. Let's say theoretically that was as much as we could possibly diversify, 300 markets. And then you take a portfolio of 4 markets within that selection of 300 markets. So that means there are a huge number of possible combinations of 4 you can select from those 300 markets. You plot them on a distribution that has CAGR as one axis and drawdown as another axis, and you get a big scatter plot, and there's high dispersion amongst all of those possible 4 market solutions for a portfolio from a possible portfolio of 300 markets. You get a massive scatter plot. What happens when you get to 30 markets? So there is less possible iterations in that total possible universe of 300 markets, but you plot the results there and you find that the scatter plots all start condensing with a higher average plot of CAGR and a lower average plot of drawdown. This is starting to go against the old Markowitz philosophy that it's all drawdowns that you mitigate with the Markowitz efficient frontier, because what they're looking at is a linear relationship there between standard deviation and the portfolio returns. So when we then go up to 200 markets, lo and behold, we find that the scatter plot, there are still a large number of combinations of 200 possible combinations of markets within the 300 markets. You find that the scatter plot, once again, concentrates with higher CAGR and lower drawdown. So there are 2 things going on there. There's the smoothness with increased diversification, and there's uplift created through increased CAGR. The reason for that is because these outliers, which are these significant anomalies, And when we talk about outliers, we're talking about beneficial outliers in our return distributions that give us our step-ups of our equity curves. They are not distributed evenly throughout the entire number of markets. So when you're looking at 4 markets within a total possible universe of 300, you might find there are no outliers in those 4 markets. When you get to 30 markets, there is a greater representation, because actually it is selection bias that you are introducing by using less markets. Because you don't know where those outliers are going to reside, in which markets. And sometimes there's multiple outliers in one market and no outliers in 10 other markets. So this entire process we're doing with maximal diversification is naturally, when I put those scatter plots together, it's like a sniper that finds that their target is continually concentrating towards higher KGAR and lower drawdown, which is the optimal for our world. So smoothness and lifting power, what better than that? And this is all because of this non-linear nature of these outliers.
Yes. No, this reminds me of a paper that I tweeted. You may have commented on as well this week or last week, which used a different word, I think, and that was luck. And these professors were advocating on trading a lot more stock. It's probably last week, a lot more stocks than most people trade, because there's more to life and to be concerned about than volatility. And so they basically said you can have this bad luck. Like you said, there could be no outliers in the 20 that you chose, and it's basically a function of not trading enough markets. But it still seems, we can pick this up later because it's not fair for me to do this, but it still seems though that outside of this unluckiness factor, that basically trading more and more markets, the biggest benefit is going to be kind of the compounding and the spreading out of these outliers more so than the concentration of them. And not only, you could be just as lucky as me in getting with your 20, not you personally, but somebody else could be just as lucky as me as getting 13% of my 20 markets produced outliers every year. And you would have no bad luck, and possibly, you would lag a bit behind due to this compounding and concentration. But I did want to finish up with one question that maybe you and Alp or whoever can explain to me. And obviously, I don't think sometimes I think I know what this selection bias means, but sometimes I don't, or what you guys mean by it. But tell me how different this is. What sort of selection bias? Let's leave stocks alone, or maybe just in your answer, compare this supposed selection bias that a person has if they have to go out and choose 20 stocks to trade or 150 stocks to trade and anything in between. How does that selection bias compare to CTAs who trade 50, 60 futures markets?
Well, it's exactly the same, Jerry. So selection bias is where you're choosing a smaller sample than the total population that's available to you. So in the case of a decision made, there's a population of 100 markets out there, I'm only going to trade 20, there is selection bias in that process because you are selecting a sample from the broader population. The broader population has these characteristics that you want, and you choose a sample from that. So your sample statistics that are produced from that don't necessarily conform with the population, depending on how you're taking your sample. A classic example of this, Jerry, was that paper that Mark Rezabczynski put out last week, which Absolute jumped onto and said it's worse than useless. It is worse than useless because they were applying this sampling bias to that paper, where they were choosing to evaluate between a buy and hold and trend following, and choosing the S&P 500 as their data to use, which is a bias in itself, recognising the performance of the S&P 500, as opposed to the performance of the Nikkei, the FTSE, all of these things. But also the time period they chose was selection bias, because they took from 1999 up to 2022 or whatever, which is perfect selection bias, because you just got to look at that chart in hindsight and you know that they're curve fitting that sampling result to that. So I was really surprised with that article from Mark, because when you dug into the detail, you just saw it was worse than useless. But this bias, and they had the nerve to talk about a form of bias in there with trend following. What was it called? I can't remember the term they used for bias. Beware of this bias. And I was saying, well, beware of sampling bias in your method. But so selection bias occurs when you necessarily choose a smaller selection than what is available to you. So you have to make a choice. And typically people make a choice based on the performance of that small sample. And so in doing that, they are making a statistical assessment based on the sample properties and saying that that is representative broadly of that population. But that is not necessarily the case. We see that you need a very large sample size, and particularly in our nonlinear world, you need possibly an infinite sample size when you get into Cauchy distributions, which in the tail regions, we might be facing Cauchy distributions there. So this whole selection bias and something like the cross-sectional methods we've been talking about also introduces timing bias into the process, because their method of rotating and rebalancing introduces timing bias into the process. All of these things are avoided with what we're doing. We're minimalising the biases in our process through our trend following absolute momentum path dependent basis. There is minimal assumptions, minimal biases, and when you start looking at things differently spatially and all of these things, you start introducing these subtle biases, which is quite significant. So you might get these smoother curves because you're effectively over-optimizing or curve fitting, because these biases are coming into play and you're dependent on the historical properties of that data, so you become locked to the back test as your means to evaluate your performance. We avoid all of that because we recognize that these outliers, these unpredictable anomalies, these chaotic regions, don't have the necessary information to allow us to adopt any of these predictable premises in our assumptions.
All right. Boy, that's amazing. I told you that class would be in session with the professor. I'll never ask that question again. I do know what selection bias means now. I do think that Richard brought up a lot of good points. One was so minimizing. That's all we can do is minimize. And so choosing these markets, not based upon the back test, but only due to some sort of perceived general idea that you may be adding diversification when you add a REIT to a drug company, to a mining company, et cetera, et cetera. And then I do think that keeping that universe fixed and not moving things in and out all the time will allow you to apply these methods and get your 13% over time of all the outliers that are going to be produced in these markets that you're trading. I think this is all we can hope for, and to minimize these biases that we have. Brilliant. Okay. Very worthwhile conversation today. Thank you guys for being here. Have a good weekend.